Cryptocurrency markets are notoriously cyclical, swinging between exuberant highs and dramatic lows. Understanding market cycles is essential for anyone looking to navigate this dynamic environment responsibly. These cycles are influenced by macroeconomic trends, investor psychology, adoption waves, and technological developments. In this video, we will break down the key phases of crypto market cycles, how sentiment shifts during each stage, and how informed participants can align their strategies with broader market trends. Press the subscribe button and hit the notification bell to stay informed with in-depth crypto analysis. Keep a notebook handy because recognizing these patterns early can help manage risk and make more informed decisions. Let us begin by exploring the first phase of the market cycle and the signals that indicate its onset. 1. Accumulation phase. The accumulation phase occurs after a prolonged market downturn when prices stabilize and investor sentiment remains cautious. During this phase, informed participants often begin accumulating assets at lower prices, recognizing the potential for future growth. Volume may increase slightly as interest returns, but general public sentiment is usually skeptical or indifferent. Detection signals include consolidation in price charts, decreasing volatility, and signs of capitulation among weaker holders. Experienced investors look for structural stability and technical patterns that indicate potential bottoms. Awareness of the accumulation phase helps participants differentiate between genuine opportunity and prolonged market weakness. It is also a time for careful research, identifying fundamentally strong projects that are likely to benefit from the next upward trend. Patience and disciplined observation are crucial during this phase. Maintaining a balanced perspective prevents emotional decisions that can lead to losses. The accumulation phase is a quiet yet foundational period in the market cycle. 2. Early bull phase. The early bull phase begins when prices start rising and optimism slowly returns to the market. Media coverage becomes more frequent, and initial gains attract early adopters and opportunistic participants. Volume gradually increases, and price charts often form higher highs and higher lows. Awareness of early bull signals allows participants to identify trends without falling prey to hype-driven speculation. Market sentiment shifts from cautious to optimistic, but widespread enthusiasm has not yet taken hold. Detection of this phase includes observing breakout patterns, increasing exchange activity, and early profit-taking by previous holders. Participants benefit from maintaining discipline, setting realistic expectations, and avoiding leverage-driven exposure. This phase rewards careful observation, research, and selective participation. 3. Main bull market phase. The main bull market phase is characterized by widespread optimism, rising prices, and media attention. Investor enthusiasm accelerates, and new participants flood the market, driving liquidity and valuation growth. This phase often sees exponential gains, where fear of missing out dominates decision-making. Detection includes sustained upward trends, high trading volume, and frequent mainstream coverage. While the potential for profit is high, so is the risk of emotional trading. Participants should remain aware of overextension, overvaluation, and excessive leverage. Understanding that markets rarely move in a straight line helps manage expectations and prepare for corrections. Professionals often advocate using this phase to evaluate profit-taking strategies and maintain a portion of holdings in more secure assets. 4. Euphoria phase. The euphoria phase represents the peak of market optimism when prices skyrocket and rational analysis often gives way to emotional exuberance. New participants enter with high expectations, believing that prices will continue rising indefinitely. Indicators include record high prices, intense media coverage, and social media trends, emphasizing rapid wealth accumulation. While some participants profit, many are at risk of entering at overvalued levels. Awareness of euphoria signals helps participants avoid last-minute overexposure and recognize the likelihood of an impending correction. Historical patterns suggest that extreme euphoria is often followed by sharp market adjustments. Risk management, disciplined evaluation, and profit protection become paramount during this phase. 5. Distribution phase. The distribution phase occurs when early investors begin taking profits and selling to latecomers, often leading to sideways price action before the decline. This phase is marked by increased volatility, trading volume spikes, and conflicting market narratives. Awareness of distribution indicators allows participants to recognize that the upward trend may be ending. Detection includes repeated resistance levels, declining momentum despite high volume, and divergence between price and technical indicators. Participants should reassess positions, reduce exposure if appropriate, and maintain liquidity for potential downturns. Overconfidence or ignoring distribution signs can result in significant losses when the market reverses. Observing behavioral patterns, trading activity, and macroeconomic signals contributes to a more informed perspective. Knowledge of distribution dynamics helps prevent reactive decision-making and encourages structured exit strategies. 6. Early bear phase. The early bear phase begins after distribution, when prices start declining and negative sentiment emerges. Awareness of early bear signals is essential for protecting assets and adjusting strategies. Indicators include downward price momentum, declining volume, and increased panic among retail participants. Market sentiment shifts from cautious optimism to concern, and fear of losing more becomes prevalent. Participants should remain vigilant, avoid emotional selling, and reassess exposure in high-risk assets. Knowledge of support levels, liquidity, and potential stabilization zones helps manage risk. Awareness of early bear patterns allows informed participants to implement defensive strategies without succumbing to panic. 7. Capitulation phase. Capitulation occurs when panic selling reaches its peak, often causing dramatic price declines. Retail investors may abandon positions, while informed participants observe potential bottom formation. Indicators include extremely high selling volume, rapid downward price movements, and widespread negative sentiment. Awareness of capitulation helps distinguish between temporary fear and structural market change. Knowledge of previous cycle lows and long-term support areas provides context. Participants benefit from monitoring on-chain metrics, liquidity, and network fundamentals during this phase. Emotional resilience and disciplined observation are critical, as the temptation to sell in panic can be overwhelming. 8. Recovery phase. The recovery phase begins when market sentiment starts to shift, prices stabilize, and early positive signals emerge. Awareness of recovery indicators allows participants to align their strategy with emerging opportunities. Indicators include upward price consolidation, increasing volume, and renewed positive sentiment among early adopters. Participants should observe the sustainability of upward trends, avoiding overconfidence while recognizing early signs of renewed growth. Knowledge of technical levels, support zones, and macroeconomic context helps validate the start of recovery. Awareness of recovery patterns assists in balancing risk with opportunity, supporting informed decision-making. 9. Secondary bull phase. After initial recovery, the market may enter a secondary bull phase, where prices rise more gradually and investor confidence strengthens. Awareness of this stage allows participants to manage expectations and align investment behavior. Indicators include moderate upward momentum, steady trading volumes, and consistent positive sentiment. Participants benefit from observing both on-chain metrics and macroeconomic influences. Knowledge of past cycle patterns informs likely scenarios for trend continuation or potential reversals. During this phase, disciplined growth and measured exposure reduce risk while enabling participation in longer-term appreciation. 10. Exit and reallocation strategies. Exit and reallocation strategies are crucial for capital preservation and long-term planning. Awareness of exit indicators, such as overextension, divergence between fundamentals and price, or market sentiment extremes, allows participants to implement measured adjustments. Observing macroeconomic trends, liquidity stress, and portfolio performance informs reallocation decisions. Knowledge of risk tolerance, investment goals, and market cycle stage supports disciplined planning. Understanding crypto market cycles is essential for informed participation in a highly volatile environment. Awareness of each phase, from accumulation to euphoria, distribution, bear markets, and recovery, allows participants to manage risk, evaluate opportunities, and make disciplined decisions. Share this video with friends and community members to help them recognize the patterns and cycles in the crypto market. Comment below which phase you find most challenging and how you approach it. Press the like button if you found this breakdown useful, and subscribe to the channel for more in-depth market analysis. Hit the notification bell to stay updated on future videos that explore trends, strategies, and risk management in cryptocurrency. Knowledge, patience, and strategic thinking empower participants to navigate cycles safely.